Good afternoon, ladies and gentlemen. Thank you for coming to the University of San Francisco today. I'd like to thank the Dean of the Business School, Elizabeth Davis, and the Associate Dean of the Business School, Barry Doyle, for making these great events possible at the University of San Francisco. Also, I want to thank our new film crew. I'm hoping they improve our conditions tremendously. Thank you. I would like to especially thank LaShonda Small and others for their help in organizing the event. Before we begin, I kindly ask you to turn off your cell phones so we can keep quiet during the presentation. And also, please try to be quiet because we don't have amplification, and so it'll be easier to hear everyone. If you have questions for our guest speakers, please write them down on an index card. There should be index cards going around, and we will then collect them at the end and ask some of those questions. We're going to do a 1-hour panel presentation. And after that 1 hour, we'll take a 1-minute break, and then we'll collect your index cards, and we'll do a 30-minute Q&A session with our speakers. One of our guest speakers, Nick Gerber, started out as an MBA at the University of San Francisco. After graduation, he took a job at Bank of America. A few years later, Bank of America laid him off. And
that was a secret.
Sorry. And so he took a class to get his resume prepared for applying new jobs. While there, he met Robert. Over here, he met Robert. And they decided that they didn't like getting fired. So they wanted to be their own bosses. They decided to start a mutual fund. They needed $100,000 to do it. Nick started asking classmates from USF to contribute some money. One of those classmates was Suzanne Glasgow. She was a little girl from Nashville, Tennessee. Suzanne barely had $1,000, but asked Nick the following question. If I give you the money, will I be able to retire with a swimming pool and have someone serve me margaritas? Nick replied, I'll buy you a blow-up pool at Walmart and I'll serve the margaritas myself. She gave him the money for a stake in his company, and now she's doing just fine. And so is Nick and his fellow co-founders. Andy, another co-founder, was a friend of Robert. So Andy was an original investor in the fund, and he told Nick something else. If the fund actually gets off the ground, I want to be the first employee. He soon quit his job and became the first employee. Of the many people that Nick asked for money to start the fund, John was one of them. At the time, John was barely out of college and had a bad habit of using credit cards to buy a lot of stuff. So he had no money to offer. Fortunately, Nick took pity on him and hired him 7 years later. Now, a full 21 years later, the company's CFO calls John fiscally conscious. So he's come a long way. I met one of the co-founders in an odd place. I was practicing at a golf course for a tournament when a gentleman was catching up with me. It was Robert. I was trying to focus on my golf swing, but he kept talking about grand ideas like giving investors great investment options, while he was also hitting great shots. He also talked about oil a lot. It turned out that eventually I started focusing less on my golf and more on our other common interest. A few weeks later, Robert Nguyen invited me to a lunch with John Love and Andy Ngim to talk about how to improve investing for people, and we've been talking ever since. Let me tell you another story about our guest speakers. Our guest speakers founded the company USCF Investments. They are probably most well known for their oil ETF and their commodity products. It took a lot of hard work to build this company. Nick and his partners worked very hard day and night to get this company to work. But not everyone works in the same way. Remember Suzanne? Well, one time, Suzanne called Nick to ask him to take a break and do something fun for the day. Nick answered the phone and said, Suzanne, why are you calling me in the middle of the night? Suzanne said, Nick, it's 9 a.m. So for you students at USF, here's the lesson. Work hard, read, think, and work harder. But it's okay if you're still sleeping at 9 a.m. John Love earned his BA from USC and is a CFA charter holder. Robert Nguyen earned his BS from Cal State Sacramento. Andy Ngim earned his BA from UC Berkeley, and Nick Gerber earned his BA from Skidmore College and his MBA from the University of San Francisco. Today, our guest speakers will speak about how they started their company and tips for aspiring entrepreneurs in the financial industry. They'll speak about lessons they learned and mistakes to avoid in running a business. They'll speak about investing in commodities over the last few years. And finally, they will tell us what's happening with oil, I hope.
We'll try.
I'm also giving them one of the most wonderful gifts I could ever give anyone. And they all get a copy of that book. I now would like to ask all of you to be as grateful as I am that these individuals have chosen to speak for the University of San Francisco. Please give a warm welcome for our guest speakers. Okay, let's start with Nick. Can you tell the audience a little bit more about your background and why you became involved in investing?
I first got involved in investing when I was at Skidmore College in upstate New York, Saratoga Springs. My father at that time had invested with Merrill Lynch in a treasury bond futures and lost $6,000 in a week. This is at a time when $6,000 was about the yearly tuition of Skidmore College. So I yelled at him, "What are you doing with my tuition?" But being a good economist student, a week later I called him back. And I said, if you could lose that much money that fast, can you also make it? And that was my start.
Okay, thank you. Why don't we ask Andy a little bit about your background?
All right. I'm born, raised, educated here in the East Bay. As you mentioned, I went to Berkeley. I got my start in investing back in middle school. So I had within an economics class, and we were trying to learn about the New York Stock Exchange. So we were supposed to pick a stock, and then at the end of the semester, we would try to figure out how we did, why we picked that stock, how it went. And so I picked a company called Nabisco, and it did really well. At the end of the semester, the lesson I learned was, hey, I could make money, I could pay some dividends, and I don't have to do anything. I go, this is for me. And that's how I started.
Okay, great. Robert.
My start was similar to Andy's. I was a fourth grader, 9 years old, and there was an hour class that we could take, and I asked my mother, what's economics? And she said, I think it has to do about business. I said, okay, I'll try that. So my fourth grade teacher, Bob Hammaker, taught us how to read the newspaper to track a stock. So the stock I followed, because I liked flying, although I have glasses, I couldn't be a pilot. So I chose Delta Airlines, and that was the beginning of my love for investments, and I'm still doing it now. So
how did that investment turn out?
I don't recall.
Okay.
But it was fun to do.
It.
Yeah, it's fun to do.
And finally, CEO John Love.
Well, I think I'm still trying to start my learning about investments, but I guess my initial start, it's kind of a cliche, just a bit of knowledge. My dad taught me as many times as he could say it all my life, always put 10% away before you do anything else. And even though when I graduated college, I certainly had some bad habits, I did have a 401k, so I was doing at least that much. And I would read, just out of interest, Money Magazine. I remember when I started with these guys, they kind of laughed at me. Andy said, Money Magazine's kind of looked at as, how should I say it? Maybe retail. I'm not sure, but I learned, yeah, a little more of that. But hey, I learned some basic stuff, and since then I've tried out a number of different things, and like I said, I'm still trying to figure out the best way to do it, as everybody is. Kind of fascinated by systems. I've probably read about 30 trading books over the last couple of years on the side, just for fun. So, just for fun, yeah. So, But I think the rest of it, I came to work for these guys in 2002, learned quite a bit then, went and got my CFA charter starting in the late last decade, so that was certainly an education, and been going from there.
Did you want to talk a little bit about United States commodity
Yes.
funds?
So we brought a little slide presentation, and I will probably skip through some of these. I won't give you guys the whole boring thing, but if we could go to the first one there. So we are U.S. commodity funds. I'll let Nick tell sort of the backstory. Ludwig mentioned it a little bit already, but Nick, Robert, and Andy actually started the firm, or the precursor to the firm, back in 1995. We're mostly going to be speaking about commodities tonight, so I'll jump ahead to 2005 and go from there. And maybe Nick will probably roll back a little bit and talk about the earlier days. But U.S. Commodity Funds was founded in 2005. We had one fund in registration for about a year and a half, I believe, which was USO, the United States Oil Fund. And that was quite an educational process for all of us. These guys, their experience was running a mutual fund. An ETF and an oil ETF was quite different. ETFs were still somewhat new, and nobody had done a single commodity ETF yet. There were only, I believe, 3 commodity ETFs at the time. So in 2005, it was a pretty novel idea. We went through the process of getting that through SEC registration, launched it in April 10th, 2006, which is was a big date for us last week because we just celebrated 10 years. And kind of snuck up on us, but that was pretty exciting. In the ensuing years, we launched 12 commodity funds total, USO being the first. The next year, we launched a natural gas fund and a number of other single commodity energy funds. In 2009, we launched our broad basket commodity fund, which we think, and I'll talk about that in a little bit, but is a pretty good product. We're very proud of it. And launched our first equity fund a year and a half ago, first equity ETF, I should say. We had experience in equities back to 95. So let's see what else we got there. So if we could head. So our goal is to kind of develop, there are a lot of ETF firms out there, more than 100. We're one of the smaller ones, but we are trying to develop products and maintain products out there that give people exposure to asset classes that are not necessarily easy to get, find new solutions to problems. We're not trying to be all things to all investors, but we're trying to fill niches where people can use our products as tools or find some new way to tap into markets, some better way to tap into markets. And we're very committed to ethics, professional standards. If any of you guys have read the CFA ethical materials or have looked at that program, that's a very, very big thing that they drive. That's important to me. That's important to everybody in the company. We want to be known as a firm that is above boards and does everything right. And there's a lot of rules, there's a lot of regulations, but at the end of the day, it's about serving investors, and we're very committed to that.
John, what's that story that you told me about the rules of ethics? Is there anything that you can mention about that? You have some list.
Well, our corporate values. Did we bring a copy?
I did not bring a copy, but
okay, then never mind.
Well, I can say that, I mean, Nick last year, as he turned over the reins to me, one of the big things he did was actually sit down and record what are the corporate value, what are the things that really have mattered to me over the last 20 years, and what do I want instilled in the company going forward. And one of those is ethics and transparency, and that's always been the case. And something that impressed me when I came to work for Nick when the company was called Ameristock. So I don't know if you want to elaborate on that.
No, this is something that we just put into writing a year and a half ago, but we, as John has said, have been trying to live it for over 20 years. I mean, Robert and I and Andy were at a conference in San Diego, 20 years ago now, and we said, what do we want this company to be when it grows up? And we decided, you know what, we have new kids, new wives, and we want to see them. So we wanted the company to have a balance between work and life. And so while we have always lived these values, it was only till last year when we started gaining new people who we didn't really know from the very beginning to how to best to teach them these values, which we think we've lived and incorporated, and now hopefully they can. So we wrote it down, and the first one is, we're not Wall Street, we're Oakland.
Alameda at the first time.
We begin with yes. So if you have an idea for a new fund, we're not going to say, it's been done before. We're going to say, all right, let's try and see, can this be done? Doesn't mean we're going to end at yes, but we're going to begin with yes.
Thanks.
Sounds good. And then next slide, please. So I just had mentioned our products. There's a complete list, but we can move ahead, and I can elaborate on those in a little bit. And this is kind of more for people looking at the company, so I'm probably going to skip a few here, but next one, please. Just so you know, a little quick intro. Our investors, we kind of have a number of different kinds of investors. Our biggest products, probably about 80% of them are used by institutional investors, so the big wirehouses, hedge funds, things like that. And then our basket commodity product, that's the product that we kind of recommend for retail, for average investors. That's the thing that I actually hold in my 401k. I would tell other people, if you're looking for diversification, that's the product you want to hold. We tend not to go after retail customers directly, so you won't see a lot of advertisements from us or anything like that. We tend to go into offices. But that's pretty much it on that slide. And then next, please. Yeah, that's easier, sorry. So I think this is probably more interesting than anything else. The ETF industry, as of the end of last year, was pretty small compared to the mutual fund industry. Mutual fund industry has, the ETF industry has over $2 trillion and growing. Mutual fund industry is actually 8 times that size. Like I said, there's over 100 ETF issuers worldwide. We do rank pretty high, but we're still one of the smaller among the big guys. There's over 1,800 products, ETF products in the market right now. When we launched our first fund, there were 600, so it's grown tremendously in the last 10 years. And it's standing at 1,800. That doesn't include funds that have closed. So there's been quite a few product launches these last couple of years. I've got some stats up there on median and average fund size. As you can see, the median fund is 53 million, I think, and the average is 1.1 billion, so there is a skew towards, there's quite a few funds that have the majority of the assets, and then a lot of small funds. And we go to the next one, please. Some trends in the industry. The ETF industry is growing very rapidly. As I said, it's 1/8 the size of the mutual fund industry. There's a very small percentage of households that actually own ETFs compared to households that own mutual funds. 50% own mutual funds, 4% ETFs. Again, that's as of the end of last year. It is growing rapidly. Last year there was exponential growth. ETF flows into ETFs actually exceeded mutual funds for the first time in history. So that was a big turning point last year. And next, please. You can skip this one and that one. So some basics on ETFs. I'm going to stand here since I can't quite see this one. But I'm not sure how familiar y'all are with ETFs, but they were first launched in 1993. Pretty much a breakthrough product. They're tax efficient. And is anybody are you guys familiar with ETFs and how they work and all that? So, okay, I won't go into
I think they are.
Okay, too much of the details. But, some of the advantages, low fees, diversification. You can get access to things that aren't easy to get access to, transparent and flexible. So, okay. And one more, and that's it.
Okay, great.
So
let's get back to some of the stuff that we can't really talk about that we want to learn about. So you started your company. You were working for another company. You started a company. So can you tell me just sort of what lessons would you give to other people? Because I think one of the tough things to do is to quit your job and start a company, even if you have a good idea. So do you have any lessons about that and your experiences and pros and cons? And all of you can talk, any one of you.
Well, don't quit your job. Get fired and get a great severance, and then meet somebody in the layoff firm that you think, I can partner with that guy. No, but really don't quit your job. I mean, it is so easy to start, not just, it's not easy to start a mutual fund or an ETF, but it's so easy to start a company these days. You can do it while you're earning money from somebody else on the side. So we said that it is difficult work, but it can be done if you're willing to put in the hours.
And if you're in the finance industry, don't do that without the knowledge of your employer, though. So.
Yeah. Do you guys have anything to add, Robert?
Actually, So after Nick and I received our papers from Bank of America, Nick used to run 2 equity index funds at Bank of America, and I used to run money there in the same department, but we didn't really know each other. And so we met in our outplacement class, quote unquote, given by Bank of America so we could find a new job. and that's when Nick, we were sitting next to each other, and Nick said, after we knew somewhat about our backgrounds, he says, "Hey Robert, I'm thinking about starting a mutual fund. Do you want to do it?" And I said, "That sounds like a good idea to me." So Nick asked one of his graduate school colleagues from USF, and then I asked Andy, who was a good friend of mine, and I was 36 at the time, and my wife was 34, and she was pregnant with our only child, and she said to me, "You want to do what?" So, but she had a good job, and so we invested, even though at that time of our lives it was a very, very risky and aggressive move. Instead of finding a salaried job. So my lesson is that I guess I'm more the risk taker in my family, and my wife is the more conservative one. But it was flat out the best move that we ever decided to make as far as the decision, because there's no way we would be where we are now as a family and with this company if we had not made that move. And so,
let me tell you a story. So, I've been in the financial service industry over 30 years, but early in my career, I was told in the financial service industry, it really attracts the brightest people and the crookedest people. Okay, and so when we first, Robert, we had a dinner at Robert's house, and he invited Nick over. And Nick was going to make his pitch about this fund he wanted us to start. And Nick came in the door, and he was holding pizza and soda. And I go, that made a really positive impression. So I know he's not going to be a crooked guy.
So what was that first fund, and was it successful? And what was the hardest thing in the early days? The hardest, each one of you, can you name one hard thing about the first year or two of business?
So we started a large cap value fund called the Ameristock Mutual Fund. Launched in 1995. Nick he did it all. He was a one-man single shop. And from the get-go, it's like a rocket ship. As it's blasting off, it starts slow and hopefully it builds momentum and it takes off. So when it got to, about $10 million in assets, I go, "Hey, Nick, are we ready?" And he said, "Okay." So I took my big pay cut and took a big leap of faith and came on board. I was the first employee. And I remember the first day, Nick worked out of his house. I went to his house, and Nick was showing me the ropes. This is in January of 1999. And the next month, he kicked me out because your son was being born.
I needed the room.
Oh, that too. So, it's how we started. It just really from the ground up, making calls, hoping, going to conferences, just hoping to get on the radar screens of investment advisors. And that's how we grew.
Making cold calls and having the advisor slam the phone in our ears.
Yeah.
That was part of it.
Well, I gave you advice already. Don't quit your job. And I took my own advice, because even though we weren't working for Bank of America anymore, as Andy had alluded to, I was working out of my house, trying to keep costs to a minimum. Plus, my wife was still working, as was Robert's wife. So we still all had income to try and do this thing. Try to diversify. As far as the most difficult thing that I found trying to do it all the first year was convincing somebody to give me their money to invest. As Andy said, the only people who come into this business are very smart or very crooked. But if you're trying to convince somebody to give you some cash to begin with, they don't know which one you are. So we had to sell not ourselves, not a track record, because they didn't know who we were, and we didn't have a track record. So we sold things that they knew. We sold trust. We only invested in the bluest of the blue chips, IBM, ExxonMobil, saying, we're not going to invest in anything that if it's a company you don't know or as a product you don't use every day, we're just not going to invest in it. We also are value people, and we like dividends. So these are things that people know and understand, and they're easy to invest in. And as Robert said, if we can talk to the registered investment advisors who talk to the ultimate client, we can make their life easy to invest with us. And we're still doing that today, is how do we make the investing process simple and smooth from the beginning person who is saving the money to the end when it comes to us.
Okay, thanks.
Can I add to that real quick? One thing that impressed me about these guys before I even came to work on them was they did this in the 90s. They did this during the dot-com bubble and before everything leading up to it. So everybody was saying, you got to be in these tech stocks. You got to be in this new economy. The rules are different. This old-fashioned way of investing, that doesn't work anymore. You've got to, these companies that are in the red, don't worry about it. It's not going to, nothing ever is going to go wrong. And these guys stuck to their guns, and the people who understood that, who believed that, were the ones that invested, and in the long run they were vindicated by what ended up happening. And the fund really had very solid performance, and I think one of the things I would go around and talk to people, and the feedback we get is we stick to the story. We don't change it. We're not going to change our investment methodology, and that really resonated with people, and it made a big difference.
Okay, great. So you created this great fund. So how do you end up being known as the most famous oil fund in the world? That's for me. That's my belief. You're the most famous oil fund in the world. How did you get from there to there, and why did you launch an oil ETF? I don't know who wants to start. Do you want to start, Nick?
Oh, that one came directly out of my own background. Because as I said, I got started by learning about my father who invested in treasury bills and lost money. So after Skidmore College, I leased a seat on the New York Futures Exchange and learned a lot about futures and commodities, including oil, which was at that time traded on the New York Mercantile Exchange in New York. Working for Bank of America, as Robert said, we ran 2 mutual funds, and ETFs at that time, well, when we're talking about the launch of USO, were still fairly new. So I took the 2 skill sets I had of knowing about futures, I need a third hand, and working and starting mutual funds to just put them together. It's actually the market research we did for USO was just looking at the Wall Street Journal and seeing which commodities traded the most. Gold was already taken, which left oil.
And do any of you have any stories about the early days of that ETF? Was it hard to get assets? Was there an instantaneous reaction by the investment community? What happened in the early days?
Yeah, there was definitely there was a pretty quick reaction. We were lucky and very lucky with timing, very lucky with a lot of things. It was a very, I think it was actually probably a 3-year process from the time Nick first mentioned the idea and kind of was just sort of noodling it to when the fund launched. And I know, he went through a rough time getting it through registration. And at one point, he had asked, the way I got involved, he said, who wants to help out with this? So I raised my hand. And then one day, he and I started educating myself on everything I needed to know. And one day, he handed me a prospectus and some phone numbers and said, here, call these people and figure out how this thing works. So we had some time to learn what we needed to do to be ready when we launched. But when we did launch, there was, I think, a lot of press buildup for it. There was a lot of pent-up demand. There was a competitive fund. I think the biggest risk we had is that Goldman Sachs had a fund in registration, or not in registration, but they were planning to do an oil ETF, and we had to kind of go up against them. Barclays also had one of the first exchange-traded notes in registration. Their ticker was OIL. At one point, they were slated to launch before us, we both kept getting pushed back from the regulators to get exemptive relief to launch. And we beat them to market by 3 months in the end, and that just made a huge difference. First mover advantage was huge in that space. So I think in the first month, I don't remember the asset levels, but we were just astounded that month after month they were growing, and then the first 2 years it just kept reaching new peaks. And by 2008, I think we were up to $3.5–4 billion in just a very short amount of time.
Right. Anyone else? Is that pretty? So your company has a lot of commodity ETFs. So I think most people know what a commodity is, but do we want to do we want to show video, or do we want to look at what you've got on the ground?
Video.
Let's do both. Do you want to show the video?
We'll do video first.
Okay. Some of you may have seen this video.
It's a good video.
Oh, William, my boy, right on time. Come in. Sit down.
No thanks, guys. I already had breakfast this morning.
This is not a meal, Valentine. We are here to try to explain to you what it is we do here.
We are commodities brokers, William. Now, what are commodities? Commodities are agricultural products, like coffee that you had for breakfast, wheat, which is used to make bread, pork bellies, which is used to make bacon, which you might find in a bacon and lettuce and tomato sandwich. And then there are other commodities like frozen orange juice and gold. Though, of course, gold doesn't grow on trees like oranges. Clear so far?
Yeah.
Good, William. Now, some of our clients are speculating that the price of gold will rise in the future, and we have other clients who are speculating that the price of gold is going to fall. They place their orders with us, and we buy or sell their gold for them.
Tell them the good part.
The good part, William, is that no matter whether our clients make money or lose money, Duke and Duke get the commissions.
Well, what do you think, Valentine?
Well, it sounds to me like you guys are a couple of bookies.
I told you he'd understand.
We are not bookies. We're the house. We also don't really care if the price of commodities goes up or down. So it'd be interesting when you do ask us, what do you think about the price of oil? And the answer you don't get. All we care about is trying to convince people that if they have a need to invest in oil or any other commodity, they use our ETFs. The more people can invest in our ETFs, the higher the asset growth is, and our fee income is based on assets. So the more assets, the more fees. So we're not bookies, we're the house. Commodities, as they mentioned, are orange juice, pork bellies, gold, but they're more than that these days. They're also futures, as I said. I was on the New York Futures Exchange. So they're things like stocks, baskets of stocks. The S&P 500 is a commodity, as is this thing, the dollar. You can buy and sell the dollar versus the euro, the pound, or the yen.
Okay, great. So let's get to how you invest in oil. Do you just buy oil and put it in storage tanks? What's the way you invest in oil? And do you have some? Sorry, no. Okay.
So, well, you guys are probably familiar with the gold ETF, GLD, and that was the first commodity ETF, and they actually do hold physical gold. That's a far cry different than actually holding oil itself. If you want to buy oil, you certainly can, and big companies are. I mean, obviously, it's a huge part of commerce, so people are buying and selling oil. But as an investor, if you bought oil, you'd basically be buying barrels that you'd have to store somewhere. You'd have to pay for that storage. You'd have to transport it. You'd have to insure it. All kinds of things go with that. So even if you put barrels of oil in your backyard, you're still going to probably want to insure it and insure your house because you don't want it to catch on fire when a lightning bolt strikes or something like that. But the way that the easiest way for an individual investor to tap into oil is or was before we launched the ETF, to buy a futures contract, to go out and open a futures account. People would typically, if you wanted to be long oil, you would buy the front month future, and we can talk a little more about futures curves if that's helpful. But you'd buy a front month future and you'd roll it to the next month sequentially, or to a couple months out, that kind of thing. And that's much easier than and much more. At times, it can be more profitable than holding spot. At times, spot may be more profitable, and we can talk about that a little bit too. But
so Ludwig asked us not to talk about legal aspects of futures or derivatives too much, but I have to mention this part because it's integral to what we do. As John said, previously, if you had wanted to actually invest in oil, you could buy an ExxonMobil, your own field. If you were a professional, you could go out and get a contract on the OTC markets, or you could own a futures contracts on the old New York Mercantile Exchange. If you had done that, you would have gone to, as Duke and Duke showed us in Trading Places, a commodities broker, not a securities broker. The two are very distinct. One is the 1933 Act, which would be commodities. The other one is the 1940 Act, which would be stocks and mutual funds. And previously, there were a lot of brokers who sold stocks, but not too many people who sold commodities. What we did with U.S. Oil is allow people who had brokerage accounts to invest in commodities. So anybody who had a traditional brokerage license could all of a sudden buy and sell oil for you versus a specialist person. So we expanded the market.
One kind of ties in with that clip you showed. We typically own tens of thousands of contracts in the fund, depending on the size at a time, and we get a fairly decent commission rate because we're trading so many contracts. But even if you guys went to and opened a futures account today, you get a somewhat decent rate. But there are still people out there. We were talking about people that were either that were smart. You said smart or corrupt, but sometimes they're usually both. If they're corrupt, they're also smart. But in the clip, these guys were talking about being the bookies. And I actually recently sat down with a broker, and he said to me, he still gets private clients into oil or gold, facilitates the trade, and charges $100 a contract. And I said, wait a minute, $100? What kind of contract? Futures contract. If you can imagine paying $100 for any kind of trade that you do today, I was just blown away. And there are still people out there that are taking that kind of money, $100 for a single contract, where you could probably get it in the range of $3 to $5. So it's pretty phenomenal that's still going on.
It's amazing you say that, and I'll say my own personal experience, which is I had a futures account, and I have to say what you guys launched before I ever knew you was a tremendous aid for the investment community, tremendous, because I closed my futures account and now I had this option. So exactly the story you're telling. I didn't pay the $100, but it was still difficult just to roll futures by yourself. So let's shift gears because we're almost at the end of our time, and then we have Q&A, and I think we'll probably get a lot of good questions. Write some good questions of what you really care about, because that's a lot of times more interesting, in fact. So I'm going to ask you some things that really people can't read about and I think are important. So can each one of you name something that you learned in your school, in any schooling from elementary all the way to college, that helps you today? And why don't we start at the end here, Robert, unless someone has an answer already. Robert, you go ahead, Nick.
Answer? Not yet.
Well, the answer I learned was here at University of San Francisco, which is you don't have a business, any business, without sales. So build a product or a service that somebody was actually willing to pay you for, have sales, and there's your business. I mean, so many people come at it the other way and backwards and say, well, let's build something great and change the world. Or I've got a great idea for a logo. That's putting the cart before the horse.
I'd second that. Sales is everything. I mean, you have to have a good product, you have to have a good message, but at the end of the day, you have to get that message to people, you have to get that product to people. Sales is definitely vital to survival and success.
Andy?
Well, it's not just the product and sales, but you need to have conviction. You need to really believe that your product or that you are offering to investors, to the community, is worthwhile. Don't just sell just because, I'm going to make a lot of money doing that. To have the conviction that you believe in what you're promoting goes a long, long way.
That actually, when I started, sorry, just to tack on to that, when I started with these guys, again, I keep going back to that, but that was a great thing about it is we didn't actually have a sales staff, so we would go out to conferences, meet with investors and advisors and people, and I could talk about the mutual fund they started and actually do it with pride and feel comfortable that it was something that was worthwhile to sell, that it actually, that there was no smoke and mirrors, there was something real there, and so it felt really good to have that to be able to do.
All right.
Robert?
Actually, I didn't learn this in school. I learned this from my mother. And my mother taught me when I was young, she said, if you want something, you have to ask for it. And so when all three of Andy, John, and Nick said, without a marketing department or sales, you're nothing. So in sales, you have to ask for something. But not only do you have to ask for it, though, you have to, as Andy alluded to, you have to be honest with yourself, and you have to be believe in what you're talking about, and that it's good and it's going to help whoever you're talking to. If it doesn't help them, you won't sell anything. So you have to go out and pursue whatever you want to, whatever you're selling, and that could be many things. Basically, it's really selling yourself, because when you're talking to someone in person, you're trying to portray being honest and open with that person. Otherwise, if there's any doubt with that person, they're not going to buy anything from you.
Okay, so you talked about your mother. My next question was exactly that. What have you guys learned from a family member of yours that helps you in business today?
For me, I think my parents taught me to be good to people and fair, and that doesn't necessarily mean that you're always nice. Being good and fair may mean that you have to sit somebody down and say things that don't make them feel good, but ultimately are good for them and are good for the company. And even when you have to make hard decisions, you want to make it not based on emotion, but make it based on what is good for people and for everyone involved. And I think that helps me sleep at night. So.
Andy?
The thing that I really learned, school, family, is perseverance. Don't give up. If you have a dream, pursue it. Don't say, I'll do it tomorrow, I'll do it next year. If you really have a dream and you got passion for it, pursue it. And you guys are all young. It's okay to make those mistakes. You get to my age, not so much. Right? Work hard. There's no substitute for working hard. Working hard and smart. Just because you put in 12, 14 hours, you might thinking you're working hard, but you might not necessarily be working smart. So be smart in how you approach and attack what you're trying to accomplish. Also, be willing to learn. Don't think you know everything, because there's always something else to learn. So always be willing to learn. And the last thing is have fun. Don't forget to have some fun. Okay.
Oh, we got you, Nick.
I'm going to go with a saying my father told me that he learned from the U.S. Army Corps of Engineers, which Nike stole and changed. The U.S. Army Corps of Engineers motto was, try it. Nike turned that into just do it.
Okay, so a couple more, and then we'll go to the Q&A. What are lessons you can tell people about managing a financial company? Now, you've mentioned that, so let me turn that a little bit around. These are a lot of students here. What kind of skills should they be gaining to work in a financial company, and what should they expect? Who wants to?
I'll do that one. I think in life, actually, and if you read big corporate leaders, that they find that the most important aspect of business, and actually in life, is being able to communicate with the other people who you're with. And so communication means if you're in a sales position to market your ETFs or your funds, you have to be able to communicate in a simple way that everyone can understand. So when you're talking about futures and commodities, that can be actually very complex, and people, because they're unaware of how they work, they're afraid of it, so they won't invest in it. But if you make it simple and you can communicate effectively in that regards, they'll learn something, and then they'll be more comfortable in investing in our idea or whatever idea that you have. So communication is crucial in any part of business and in life.
I would say know what you're talking about, learn whatever it is that you're passionate about. Don't make a cursory attempt to find out a couple of facts and then fake your way through things. People will see through that. People really value deep knowledge and experience. It doesn't mean you have to be an expert on day one of a job or anything like that, but things just like if you're doing a job interview, going in and knowing something about the company helps and goes a long way. But also when you're out in the field, whether you be selling or you be just talking to colleagues, just having the confidence and the knowledge that you need to talk skillfully about your subject matter really pays off in the long run. And so take the time and learn what you need to learn. As Andy said, there's always something to be learning, and stay on top of things. I think the people that are most valued in our industry often do have just a passion for the material, and they can rattle off all kinds of things about asset classes, investing methodologies, you name it, whatever it is. They've got some kind of passion, some kind of credibility that people are going to respect.
Communication and passion and deep knowledge are wonderful things. I don't know what I can add except history. I was walking over here today and past the Matson building. May I have a show of hands of people who knows what Matson used to do? They were shipping line. They were huge in sugar, a commodity between Hawaii and here. Matter of fact, they used to do the old C&H, which stands for California and Hawaiian Sugar. So, as John said, deep knowledge really impresses somebody. And financial services have such a long history that if I'm talking about Kruger, you should know who he is. Or the Match King, you should know what that is. Or if I say, you know what, this panic reminds me of the 1907 one. I don't want a blank stare.
Thank you. That was really good advice. All those advices were good, so I hope people take that to heart. Okay, we're getting close to the Q&A session, but the question that I've left for last is probably what most people are thinking right now, which is, what is going to happen to the price of oil?
Nick already said that you're going to get a non-answer, and to some degree he's correct, because anybody who tells you they know where the price is going to go that's ridiculous. But you can certainly make probabilistic judgments about what's going to happen, and to do that you want as much information as you can have. I brought along just some of the basic data that we can look at. We can also talk briefly about some of the things that have happened in recent days and weeks. This chart you're looking at, I don't know how closely people follow oil, but this is 1 year of supply data versus the price. The blue vertical lines are U.S. inventory, and as you can see, it has been climbing dramatically throughout since last year. I have a longer version, which I'm going to show in the next slide in a second, but what I wanted to point out is this is something that's worth, if you track oil, looking at every week, because where that blue line on the far, the y-axis on the right, where that ends up is one of the big things that's dictating where the price is going this week. And what the trend in that line is another thing that's dictating that. One of the important things on this chart is not just what the trend of supply has been, but how much higher it is than the red and yellow lines. The red line is 1 year ago today. The yellow line is the 5-year average for supply. So I hope I'm not boring anybody, but what you can really see is that we are just hugely above where we have been just a year ago and where we have been over a trailing 5-year average. And it's a phenomenal story. You can see the price, what it's done alongside the supply data. But if we roll to the next slide, this really tells the story. This is 20 years of the same thing. The blue mountain is 20 years of U.S. oil inventory. That's all inventory in the country, not just one place like Cushing, Oklahoma. That's everything. The yellow line is that trailing 5-year average. You can see that, pretty much every once in a while we go above the 5-year average. We go below it here and there. But all of a sudden it blasts off in 2014, and it just is just hugely above wherever we've been before by a wide margin. And that is what this oil story has been for the last 2 years. In fact, it really takes an exponential push up in it was called the Thanksgiving surprise of 14 when the Saudis said, we are not going to cut our production. Everybody else is just going to have to do what they're going to have to do, and that's what killed the shale industry in the U.S. If you roll forward one more, this is another very telling chart. The thick blue line is the rig count in the United States. That's the number of rigs that are actually drilling for oil at any given time. If you saw this just a few years back, it had a dramatic upswing from 2009 up through 2014, end of 2014, kept rising a little into 2015, and then it just plunges. And it started plunging because of that Saudi decision and because prices had plunged, so it was becoming less and less profitable to drill for oil. So what happens as that line drops off, the lighter blue, the mountain chart, that's production. And you see something very interesting, which is that even as the rigs are just, it's a crash in terms of rigs, production is still rising. And it did trickle off a little bit last year, and then it leveled off. And it just in the last 6 to 8 weeks has started to drop again. And the number again this week was positive. By positive, I mean the production level is going down, and so that's a positive for the price. But this really, these last two charts tell the story. And then the next one, please. This is just the futures curve. I was going to, in case anybody needed a background on futures, I was going to go through that, but we can skip this one for now. This last one is supply, global supply and global demand, and it's the last very telling one. As you can see, over the long term, supply and demand are pretty evenly matched up. I've got the price on there as well. You can see when we tend to have supply under demand, the price takes off, but pretty much you can see them up, in line up until the very last 6 quarters on the chart. This is trailing information, by the way, so we've probably got another 2 quarters on this that we'll be able to add soon and see about 2 years of this. But you can see that all of a sudden we just have multiple quarters in a row where global supply is exceeding demand, and that is the whole reason that the price has done what it's done. Now, the rest of this year, this was obviously an extremely exciting week for oil. The OPEC meeting that occurred on Sunday, everybody was expecting, actually nobody really was positive what was going to come out of that. I think pretty much the consensus was they're not going to make a deal, and that's what ended up happening. I think everybody thought that would be bearish if they came out of there, especially if they were argumentative, which they were. I think that was the only surprise, is they were more argumentative than was expected. They kind of aired more of their grievances than expected. So you'd think that the price would plunge, but there was a true surprise, which was the Kuwaiti oil strike, which occurred right at the same time. So the oil price actually, it went down after the announcements came out from the OPEC meeting, and then it actually recovered most of its ground in the short term. So over the last couple of OPEC meetings where there's been a surprise, or a negative surprise, the price has plunged, and this one, it just kind of sat there, and the production numbers that came out this week, the inventory numbers have been pretty good, so we've had a fairly good week. Where is it going? That's a guess, but I mean, it does seem like supply and demand are coming back into balance. The one thing the market has not been pricing in, maybe a little more now, but is supply side shocks like the Kuwaiti strike or something terrible happening in the Middle East that could really send the price flying back up. I personally think with everything that we know right now and short of a crisis, you're probably looking at some recovery towards the end of the year. You're probably looking at the beginning of a supply-demand realignment as we get into the rest of the year. But it's not going back to $100 this year, or I don't even think necessarily in the next 5, unless there's some kind of shock.
Okay. Anyone else want to add to that?
To the price of oil, or just investing in general?
Well, you can also, after oil, we'll do your last comments to the group.
Which could be investing in general.
Yeah.
So I'll pass.
Okay. So, anyone with oil want to touch oil? John did a very good job.
Well, thank you.
I'm just later. I might be going to my brokerage account. Robert, nothing on oil. Okay, so let's end this session with if you could just say something, some last minute statement about investing in general to the group.
So I could have held on to this.
Yes.
He said he's going to ask us some questions and prepare for one, which is what would you invest in? And obviously what we've already touched on is invest in yourself and your own education. Have a passion for something and learn history. But there are also 2 other things you should know about, and we're going to shape the investing landscape. One, your entire life, and the other one over the next 5 to 10 years. The entire life one is the Moore's Law and the law of the telecosm. Moore's Law basically says that the price of computers and chips and phones will go down and down and down while their power increases and increases and increases. The phone you have in your pocket right now has more circuits, microchips, logic, and smarts on it than the Apollo 13 mission did that went to the moon. If you can try to figure out what's the next step of Moore's Law, and its corollary, the law of the telecosm, which says bandwidth, communication is going to get cheaper and cheaper and cheaper and broader and broader and broader. You used to not be able to do videos on your phone. Now you can stream things to your television or your computer. Nobody even's going to have a television in the near future. What are the second and third corollaries or factors that come from those 2 huge things? And if you can figure out how to take advantage of it, ride it. Or if you could figure out, you know what? There's a company that's in its way. Don't invest in it. That's another way to make money, is by not making a mistake. One of the first things we did in Ameristock was get out of Eastman Kodak. We saw this trend coming, and we said, you know what? Cameras someday will be digital. We don't know if Eastman Kodak's going to have a digital camera or not, but the odds of one company surviving a tectonic shake from one industry, from one technology to the next, are never good. And even if it survives, it's not going to have 80% market share. So we just got out of Eastman Kodak and it went bankrupt. Today, Google is working on autonomous cars. And they've even said they think that means there's going to be less roads in the future. So it'll be more environmentally friendly. And if you think about it, that's probably true. The cars got to talk to each other. They can actually just use one road, and as they come to each other, one goes out of the way. They don't need 2 lanes all of a sudden. So if you want to invest in Lafarge or some asphalt company or aggregate company, be mindful that they're in the way of Moore's Law and the law of the telecosm, as are stop signs. The other point I wanted to bring up about what to invest in is more of a thought question. This one's 5 to 10 years. Milton Friedman had said, inflation has been and always will be a monetary phenomenon. Now, he got a Nobel Prize for saying money times the velocity of money equals price times the quantity of goods. And if we know that velocity is going down, which it is, and if we know that the quantity of things, our economy in general, is not as robust as it really could be, and we also know that the Fed is putting on the gas when it comes to QE 17, what's that mean for price?
Could everyone give us a big hand for our guest speakers? Welcome back, everyone. Thanks for coming tonight. Hopefully you're enjoying it. Now we get to some questions. I'm going to start with a few here. First question is, what is the greatest misconception about investing? And for these questions, you can all answer sort of briefly, or maybe one or two of you answer. What is the greatest misconception about investing?
I'm going to go with the time value of money. People don't seem to understand it at all. They want to buy a stock and next week sell the same stock to make some money. But they don't realize as soon as you sold it, as soon as you bought it, you've incurred commission, slippage, and taxes. By not doing things sometimes, and getting time on your side, you can make more over time.
I'll add to that one because when we first started Ameristock Mutual Fund, I put in $6,000 for as an investment in the fund itself, and it's been around. Even though it got bought out in 2012, I think it's worth time value of money. I think it's worth maybe $35,000 after 20 years.
That 10,000.
Yeah, that 6,000.
6,000 is now
worth like 35. Yeah.
Do the Ameristock Mutual Fund.
Yeah, and that's just a regular mutual fund.
Okay.
I think one of the biggest misconceptions is investing in stocks is a gamble. It's a risk. It's like like a casino, and it is if you just kind of like shooting blindly at the market. If you do take your time, do your research, stick to what you know best, I think you end up much better off than someone who's just kind of randomly selecting a stock.
I guess for me it would be believing that there are some kind of magic gurus out there that have the total answer, that have just figured it out, and if you just do what they do, you too could be rich. In most cases, those people have had a string of luck. They might be very smart, but of all the smart people out there, some people are going to rise to the top, some people are going to not do so well, and you just have to find a smart, sensible methodology that works, and a lot of times that's just like Nick said, it's just good old-fashioned common sense. And if you want to try more esoteric things, then do that with a small part of your income, but don't follow somebody blindly down a path. A friend of mine for a couple years after the financial crisis was just making tons of money. I could not understand how. He was just exponentially making returns, and I kept asking him, what are you doing, and he would tell me, and I'm like, this just sounds crazy, and he's telling me to try it, and I said, I just don't have the stomach for that, and of course he ended up losing all of it. 5 years of work just, so they made some of it back too, so smart guy, but I don't think any one person has it figured out. You've got to find what works and stick to what works for you.
Okay, thanks. What was your happiest moment or best investing moment? Andy, why don't you start?
Investing with Nick. Sometimes you bet on the jockey and not the horse. And with Nick, bet on the jockey. So thank you, Nick.
Welcome.
Well, I'm just going to skip ahead and say the obvious one. It's the next question is, what's your worst moment? And my worst moment was not investing with Nick. So.
Well, my best memory and investing moment then was going to be a shout out to my wife, Melinda, who when we first got married and I was telling her about all these things, and I said, you know what? There's a conference in Chicago, but it's very far away. I haven't signed up for it. It's very expensive. And she said, that's nice. Get on the plane.
Mine's the same as Andy's, investing in the fund with Nick. However, I have a bad moment of that too, because I actually was going to do twice the amount, but my wife didn't want to. So we have half and half.
Half and half. Okay, so do we have to do worst moment then? Do we have worst moment?
The worst moment is being married to an investment too long. You know, if things are going south, it's probably a really good reason for that. Get out. I won't tell you my horror story, but it's happened.
Did it go to zero?
Very close. Very close. I wrote it up and wrote it all the way down.
Zenron, right?
No, but close.
Yeah, I already did my worst, and I can't think of a best. I'm pretty boring, so.
Well, I can tell you that I've done what Andy has done many a times. But I also have been on the other end where where you can make a lot of money. So I would say, well, for me, investing is fun, and doing research is fun, and so for me, it's enjoyable. But if you want to invest money for yourself and for your family, I think you should do the research and do it on your own, because everyone in this room is smart enough to do it on their own. So I think, although we make our living as advisors for, investing other people's money, I think everyone can do it on their own if they have the passion and want to do it.
So as you can see, we do have a passion. We're still fairly young. We've got a good 20 years out of us. So I'm going to say my worst moment has yet to come.
That's very positive. So now, what advice would you give? We sort of asked this earlier, but if you have something else to say, what advice would you give to business students and film students? And John will have to explain why I said that.
I didn't want to have to explain that, but I went to film school. My dad told me, I'll send you to any school you want, but once the day you graduate, you're on your own, and I believed him. So I went and got my friends went out and got internships and low-paying jobs and all these horrible things. I decided, well, I'm going to get a real job at a solid company, move up, and I'll write scripts on the side or something like that. And of course, I didn't do that, and I started working during the dot-com era. So there were a lot of opportunities for young people, and that was fantastic. But you asked that, so that's why he said that about film school. But I'd say this applies to anything. I mean, whatever it is you choose to do, don't blow it off. Work very, very hard. And if you're in a new job, I think that a lot of people, they get impatient, or they think this isn't going anywhere. I'll never get to where I want to go. But I mean, this is going to sound kind of trite, but I think really going in every day and doing the best job you can at whatever it is really makes life more meaningful. And just say, hey, this is what's in front of me right now. I'm going to do the best I can with this. The next thing is going to come. It really is. It's going to pay off in the long run. And doing that hard work, like we were talking about with Nick, not even knowing the time of day, really does pay off in the long run. And as you said, with film school, I didn't have the financial education. When I came to work for these guys, I really had to, on my own, break out the books, start learning things, consider going back to school, but work alone was kind of an education. And then I went through the CFA program to just give myself some of the foundational stuff that I might have missed earlier, and that was fantastic. But you just got to work hard at it and stick to your guns and never give up, as Andy said.
Here, I'll let you in on a secret. So, way back when we were first beginning, and we needed to look for another employee, and Nick goes, hey, I have a friend, this guy John. He knows nothing about the financial service industry, but he's a really good guy. Why don't you interview him and see what you think? Came in, Rob and I sat down and spoke with John for, I don't know, a good hour or so, and at the end, I turned to Rob and go, this guy's not going to work out. What does he know about our industry? But let's give him a shot. What do you think? This is what happened.
Now he's running the company.
Any down here?
What was the question?
Question is, what advice would you give to business students? But you already may have said this, but okay.
Yeah.
So,
yeah.
Okay, so let's move to the last one. Last question, then we get to the audience questions. Is there and I hate to put you on the spot, John, or Nick, or Robert, but what investment trade do you really like right now? And you're willing to tell us?
A trade?
At the end of the day, this is not, I said I was boring, this is boring. The one thing that works is diversification. They say diversification is the only free lunch. I don't know what is going to make you rich by the end of this year or the end of 5 years, But I do know over the long run, the thing that's going to make the line go from here to here is having a diversified portfolio that's broadly allocated. So when some things suffer, other things go up, and you get the compounding effect of the positive returns. So to me, it's being broadly diversified, and I'll throw a shout out for commodities. They've been beaten up for 4 or 5 years, and inflation has been tepid. Commodities are positively correlated to inflation, especially unexpected inflation. So I think I can't say when, but I think that they will have their day again. So it's a good thing to allocate to. But if you're trading one, be smart. That's a tactical tool.
Anyone else? Andy? Robert?
I'll go with be a long-term investor, not a trader, because if you invest in some company, which is in your eyes a good company and has a good outlook, that you can invest in it till the day you die, just like Warren Buffett says. It's very true. You can create a lot of wealth for yourself if you just stick with a few good investments, and that's all you need. So that's kind of the opposite of what John said about diversification. But I know so because, through experiences. So
I don't give out investment advice, but one piece of information that has not come up yet is I'm also the CEO of a small public company called Concierge Technology.
Thank you. We'll have to figure out later what that means. So here are the audience questions. Why has there been, and let's just pick one person to go with this, but someone could add to it. Why has there been such extreme volatility in the commodities complex, and will it continue?
You want me to take that? Yeah. Commodities, a couple interesting things about commodities. One is, if you look at a basket of stocks like the S&P 500, they're all going to be pretty highly correlated to one another. I think the average pairwise correlation is about 0.8, whereas with commodities, it's much, much lower. There's no reason that wheat and oil should trade together. So one thing you get is that different commodities, that they don't tend to move in lockstep. And when you have a lot of uncertainty in the market, like you've had with oil, you tend to get that volatility. So volatility will continue, but I would say it's going to shift between certain commodities at different times. Also, commodities tend to be more volatile actually when they're going up, because when the commodity price is going up, that means there's actually something wrong in the market. There's a shortage of supply, there's not enough, or demand is exceeding supply, and we can't produce enough of a particular commodity. So there tends to be more volatility and more upside surprises, which is a very interesting attribute of commodities. But they're going to remain volatile, but which ones are volatile at given times is going to change.
Okay, next question. This is a tough question. And by the way, you can volunteer to skip questions.
And I'm sorry, can I add one thing?
Yeah.
Sorry to that. There is a misconception, though, that commodities are more volatile than stocks. Individual commodities can be at times more volatile than a stock. If you're using leverage, yes, you got a heck of a lot of volatility. But if you trade commodities the smart way in a diversified basket, it's been found that they have equity-like returns, and they don't have any more risk than stocks. They're about equally as risky as stocks, and they're not correlated with stocks and bonds. So they do have positive. So when I say volatile, we may be talking about a specific commodity at a time or a certain basket of commodities. But if you're broadly invested in commodities, the volatility is significantly lower than I think the general perception of them is.
Okay, thank you. So this one has to do with transition. So I'll ask, and by the way, if the question you want to skip it, please tell me. So the question has to do when there's a transition from one CEO to another. How do you make it? How do you resolve the transition? How do you make it happen fluidly?
You want to start? No.
You have to be transparent and above board. I mean, you're smart. The people who are going to be working for you are equally, if not smarter, because they're the actually ones, the people doing the job. We're just managers. But if you say, this is why one CEO is out, this is why one CEO is now in, we're a team, we get behind the person who's leading us, and that's how you do it. Like a Band-Aid, rip it off.
And I just add to that, when Nick and I sat down, when Nick offered me this position and said, I'm going to move on to concierge and I want to make you CEO of U.S. commodity funds. We sat down a number of times and he said what he expected, and I also said, I want you to know, here are the things that I think I'm going to do. Here's my philosophy on this. Here's my attitudes towards this. So he knew what kind of person he was getting as well, and there wouldn't be any surprises. So I think that hopefully helped.
So this is a question that is, I think, interesting to ask as well. When you say, quote, you don't care about the price of commodities, doesn't long-term downward trends limit the people that would invest long a commodity and reduce your business?
Commodities have an interesting phenomena. They revert to the mean. So if the long-term price of orange juice is going to go down, you're going to get less people picking oranges because it's just not economic for them to do so. When they do that, the price will revert to the mean and go back up. So that's kind of interesting thing about commodities. So no, we're not that interested in day-to-day fluctuations of the price.
I would add, and that's as us as the issuer of these products. But from an investor standpoint, we have two classes of products. I talked about it real quick, but we have tactical products like oil. That's where you're not gonna buy oil and hold it for the rest of your life. Probably that would be, you're going to go up, you're going to go down. You're going to have, if there is a long downtrend like there's been in natural gas for the last 7 years, then that's certainly going to impact your return. But I would not say that commodities taking them as an asset class has a long-term downtrend. In fact, if you invest in commodities the right way, as Nick said, the average commodity has a mean return of 0. But if you rebalance in a smart way, if you get in to commodities that are low priced and you sell the ones that are high priced, you do tend to have, over a very long term, and shorter sliced up terms in between, you do tend to have positive returns. They can be an asset class when used correctly.
Also, a commodity price will never go to 0. Andy has already talked about one of his mistakes, and it went bankrupt. It went to 0. He lost 100% of his money. And unless you're going to use leverage, if you invest in commodities, it'll never go to 0.
Okay, here's some interesting questions about starting up. Were there points when you started the company where you said, what the hell am I doing? What kept you going?
Andy says,
we can skip that too.
No, that's a good question.
I was going to say, Andy says, what the hell am I doing every day?
There's a lot of that. When you're trying to get a business off the ground, there's a lot of sweat equity. And sometimes you don't know if that sweat equity is going to pay off. I go back to, if you believe in your product and have that conviction, it's worth sticking to it. The hardest part, I think, is if it does kind of get off the ground, and it gets to a point in a small business where you now either stay small or you're going to invest even more capital to grow it even bigger. That's a tougher decision to make. Sometimes because of you built up this business to a certain point. Now what? Do you want to stay there, or do you want to grow it even larger? What do you have to do to make that next step? And sometimes it doesn't pay off.
Okay, I think we have time for just 2 more questions.
Well, hold on a second.
Sorry, go ahead.
Andy said that sometimes it doesn't pay off. Sure, there are mistakes that we've made, definitely, where they didn't pay off. However, you still have to continue to grow and try different avenues to find new growth, because that's the name of the game. Otherwise, you just be still and stagnate and go out of business eventually. So even though you make these mistakes and you spend capital in this area, you can still, we still always think of expanding and trying new ideas and going in different directions to expand that growth.
Okay. So this question says, how did your company deal with the financial crisis, and what did you do in order to survive and still come up on top?
Is it the global financial crisis
Yes,
or the dot-com area? Because we actually did great on both those times.
I think they're referring to 2008.
There wasn't much of a hit in the commodities field during 2008.
Yeah, we had, I mean, our two biggest products, there was a lot of movement in oil in '08. There was a lot of interest in natural gas in 2009. So we kind of were counter-cyclical as a business, not necessarily the commodities themselves. But we had some of our strongest flows during that time, especially as people were fleeing equities. I mean, people were getting out of all risky assets, but as we talked about, a lot of institutions that use our tactical products were pouring money in. So it was actually a pretty good time for us.
Okay, so last question, and then by the way, when we finish, if you want to speak to them more, feel free to come up and chat a little bit. What is the company thinking about in terms of new products in the future? And you may not want to answer that.
Yeah, that's what can I say? We've got something in registration, which is a mastered limited partnership product that we're actually partnering with another innovative firm on. Beyond that, we're not able to talk about the specifics yet, but we're always looking for something new, and all of the low-hanging fruit in the ETF space has been taken, but there's still a lot of very interesting ideas that people have out there in terms of innovation. So we're always trying to kind of find something new. And we just went around last fall. We had a list of something like 32 ideas that we talked about pursuing, and most of those we didn't end up doing, but some of them are still on the back burner as potential things we might do in the future. So no, that's not much of an answer, but.
So if you have an idea.
Yeah. We begin with yes.
Yeah.
And on the concierge side, we are trying to create a little. Can I do an ad? Well, we are always trying to create a little conglomerate and looking for private, small, profitable companies with management in place. I can't add it to you, and I don't want turnarounds.
Thank you. I can actually help you with that. We'll talk after. So thank you very much for coming. And again, please come up if you'd like to speak to our guest speakers. Thank you very much.